Just last month, SpaceX pulled off the largest IPO in human history at a staggering $1.77 trillion valuation. But right now, the stock is sinking. The market is staring down a massive valuation gap, and the tension driving this entire sell-off comes down to a single terrifying number.
Beneath all the hype of reusable rockets, global satellite internet, and visionary leadership, this company just posted a massive $4.27 billion GAAP net loss. And here's the kicker. That wasn't over an entire year. That was in a single quarter, just the first 3 months of 2026. This is the brutal reality hiding right under the surface. So in this explainer, we're going to unpack exactly what is happening inside this company. We are looking at the hidden financial mechanics, the XAI cash furnace that is literally consuming capital at an unprecedented rate, and ultimately why the market is terrified of SpaceX's $29.1 billion debt trap. Let's get into it.
First, we have to look at the cash flow engine. Because to understand why this massive debt load even matters, you need to understand how SpaceX actually makes its money today.
Look at 2025. They generated an incredibly impressive $18.7 billion in top-line revenue. But the big takeaway here is that they aren't just a rocket company anymore. They've evolved into a three-headed technology utility. You've got space logistics, global telecommunications, and now high-performance compute. This isn't just about launching metal into orbit. This is about owning the foundational infrastructure of the future across three massive total addressable markets.
Let's break down where that cash actually comes from. Connectivity, which is Starlink, is the undisputed cash cow. It drove $11.4 billion, making up 61% of their top-line revenue. This is a recurring subscription model selling broadband to remote households, airlines, and sovereign defense agencies that absolutely rely on it for secure global communications. Then you have the space segment. This is their legacy launch monopoly, bringing in $4.1 billion from NASA and commercial satellite operators who, frankly, have no cheaper alternative. And finally, there's the newly integrated artificial intelligence segment. This pulled in $3.2 billion by renting out massive GPU cloud computing capacity to enterprise clients alongside selling Grok subscriptions to advertisers. They've essentially built an interconnected digital and physical empire.
And the foundation of this entire competitive moat, vertical integration and radical cost efficiency. Let's talk about their reusable flight architecture. By landing and reusing their Falcon 9 boosters up to 34 times, SpaceX reduces the marginal cost of a launch by 50 to 70% compared to legacy expendable rockets. It's a total game changer. And this cost advantage doesn't just help outside customers. It lets SpaceX deploy its own Starlink satellites at a mere fraction of what competitors have to pay. Think about Amazon's Project Cooper. Amazon literally has to pay competitors to launch their satellites, while SpaceX just fuels up the exact same rocket they flew last week.
That kind of operational dominance is exactly what allowed the Starlink segment to hit a staggering 64% adjusted EBITDA margin in the first quarter of 2026. 64%. That is the high-margin, recurring cash flow engine that the entire bullish thesis is built around.
But that brings us to a massive, glaring conflict, the $29 billion trap. Because if that core engine is so incredibly profitable, why on earth did the stock plummet from its $225 post-IPO peak all the way down to just $123?
It's because the market is deeply concerned about a fundamental financial mismatch. Take a look at this. In Q1 2026, SpaceX pulled in $4.7 billion in revenue, which is up 15% annualized from their 2025 baseline. Amazing, right? But that revenue was completely wiped out by a $4.276 billion GAAP net loss in just 3 months. And by the way, if you like deep evidence-based stock breakdowns exactly like this, make sure you're subscribed.
So where exactly is all that cash going? Well, the February 2026 merger with XAI basically strapped a capital-intensive rocket to the company's balance sheet. They are building out the Memphis-based Colossus supercomputer, which is packed with 220,000 NVIDIA GPUs. To put that kind of scale into perspective, powering those GPUs requires roughly the same amount of electricity as an entire medium-sized city. The infrastructure burn here is so intense that Q1 capital expenditures top $10 billion. That completely drained their cash reserves from $24.7 billion down to $15.9 billion in a single quarter. The AI segment alone posted an operating loss of nearly $2.5 billion. Elon Musk's AI cash furnace is quite literally siphoning away Starlink's profits to fund a terrestrial AI war.
And compounding that fear is what's happening to the cash cow itself. Yes, Starlink's active subscribers surged to 12 million by June 2026, but the average revenue per user, the ARPU, has dropped dramatically.
We're talking a fall from $99 per month in 2023 down to $66 in Q1 2026. As they expand into much more price-sensitive emerging markets to keep growth alive, it directly challenges the narrative that SpaceX has unshakable pricing power. Now, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, for quality businesses built to compound for years; hidden gems, for under-the-radar names with asymmetric upside; and dividend hunters, for durable income with the fundamentals to back it up. They also have Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code right here on the screen. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, getting back into it, let's put the emotion aside for a second and look at an objective scorecard for SpaceX's business fundamentals based on the hard data.
The data gives us a 7.2 out of 10 blended score, which reveals a beautifully complex tension. On one hand, you have a 9 out of 10 for both market position and track record. I mean, they command an estimated 90% of commercial payload mass to orbit. Their technical execution is unmatched. It's practically an unassailable moat. But on the flip side, you have a 5 out of 10 for financial health and a brutal 3 out of 10 for profitability. The business is severely hindered by weak GAAP profitability, the rapid depreciation of all that AI hardware, and a deeply debt-burdened balance sheet.
So how does this massive tension between a legendary operational moat and a deeply strained balance sheet actually play out over the next 5 years? Let's project the 2031 valuation.
Before we dive into the math, I want to be perfectly clear. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is absolutely not financial advice. The stock could go much higher or much lower than any of these scenarios.
Let's look at how the math builds. In our base case, which we assign a 55% probability, we assume Starlink's ARPU stabilizes around $65 per month, and the next-generation Starship rocket is fully operational by 2028. Operationally, this means the company reaches $187 billion in revenue by year 5. Assuming a healthy 15% free cash flow margin, the market awards them an 8x exit price to sales multiple. This yields an implied share price of $98.42, which, notice, is still below today's current price of around $124. Now, if they stumble, that's our bear case. Say ARPU drops to $50, AI assets are heavily underutilized, margins shrink to 5%, and the multiple collapses to 4x sales. That implies a brutal drop down to $22.22 a share. Finally, the bull case. To justify a 12x exit multiple and hit $291 a share, SpaceX needs absolute technical perfection. That means rapid Starship reusability by 2027, massive scale and direct-to-cell mobile, and an expanding 25% free cash flow margin. It's possible, but it requires flawless execution over the next half-decade.
Which brings us to the critical risks, and ultimately, what could break this entire thesis. For investors, the vast distance between that $22 bear case and the $291 bull case really comes down to a few critical risks. The most dangerous one on the board? Capital allocation. Right now, SpaceX is operating with a massive funding gap. Capital expenditures outpaced operating cash flow by $14 billion in 2025 alone. To bridge that gap, the company took on $29.1 billion in debt. Now, if management keeps siphoning Starlink's profits to fund a highly speculative, cash-burning AI war while interest rates remain elevated, their refinancing costs will absolutely soar. The result? Management will be forced into 1 to 5% annual equity dilution just to survive the cash burn, and that kind of dilution could permanently crush minority shareholders.
So what happens next? What should you be watching? There are 3 specific upcoming catalysts. First, keep your eyes on the Q2 10Q financial filing coming in mid-August 2026. This is going to be the market's first real look at whether Starlink revenue is actually stabilizing. Second is the imminent Starship Flight 13 test mission. This is critical for proving they can consistently deploy those heavy, next-generation V3 satellites. And finally, late August brings the expiration of the IPO lockup restrictions. That is a major event that could flood the market with shares from early insiders, putting even more downward pressure on the stock.
Ultimately, SpaceX is the most dominant aerospace platform in human history. Its competitive moat is virtually untouchable, but the trillion-dollar question remains. Can Starship's orbital economics scale up fast enough to outpace the XAI capital furnace before that $29 billion debt trap closes? The tension here is incredible. Now, if you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.